Oh my God, you're going to love it.
Welcome to the AI Chicks, where we're providing you cool conversations about AI for all, with each episode covering a different topic on how AI is impacting your and our daily lives. I'm your host, Aisha Wynn, always coming in hot with that fun, unique perspective on tech. And I got my girl here.
Hi, guys. I'm Lana Hout, and I'm bringing the curls, the charisma, and that entrepreneurial energy.
I'm trying to be like Lana today and bring the curls as well.
I know, the curly twins.
We are getting into AI and venture capital today. Lana, this is so up your wheelhouse.
I know. I'm really excited. We're going to hear today from Kim Nixon of Open Venture Capital.
Let's get into it.
We're talking today about AI and venture capital, and I'm so excited that we have Kim Nixon on.
Excited to be here.
So tell the listeners about yourself and your background.
Sure. I am Kim Nixon. I'm founder and managing partner at Open Venture Capital. And I came to venture in a very circuitous way. I held product marketing and sales roles in big companies to small, some startups, some public companies, all within the health and wellness space. And my last two roles were for a PE-backed company and a VC-backed company. And I was spending all my time sitting in these boardrooms, defending my budgets, trying to figure out these revenue targets, very ambitious goals. And I just started to think about how much domain expertise I had, but not control of where the capital was going. And I started to think about what it would feel like to have both access to the purse and be so close to the consumer at the same time. Wouldn't that make me a little bit of a differentiated edge as an investor? And so that's the approach that I took in starting the fund. I did not know I was starting a fund. I thought I was starting a tiny little family office. In my last role, I had a lot of exposure to the venture team. I spent a lot of time with the team there, and I had access to deal flow. And so I was like, oh, maybe me and my friends can write some angel checks, And that was kind of where my thought process started. The more that I spent time thinking through and understanding the landscape, the more I understood just how closed alternative assets as a whole, private equity, venture, crypto, if you want to include that, but just how closed those asset classes are. You kind of have to know someone to get to the right deals. And also, you're not necessarily in the position to diligence these deals really well unless you're doing it over a period of time. And so I wanted to create a fund that felt like you have access to the type of expert that knows this space well. I have access to the deal flow that is unique and differentiated and early stage. And I'm going to put the effort in to make sure that my LPs, my limited partners, or my investors get the education that they need to understand the asset class, get the time that they need. And I was also at the time taking on smaller checks so that this could be something that was more accessible. That's why the fund is called Open. I'm, it's essentially opening the asset class. And so starting in health and wellness, which included sport as a subcategory, and over a period of time, sport became a bit bigger of a focus for us out of Fund 1. And so as we go into Fund 2 and beyond, we'll be 50-50 on the health versus sports side. That's how the fund came about.
That's an epic intro, really giving all of the layers and the details of where you got to today. Probably our listeners are like, what does she mean by small check versus big check? What's the range that you've experienced within your career?
Well, this is the most interesting part for me. At some point during my journey, I asked someone that has access to the PE space, what would it be like for me to be an LP? What does that entail? What does that look like? And they just said 7 figures. And I'm like, well, how many figures? What's that? Okay. I was like, okay, like $1 million. Immediately, the answer was almost meant to kind of be like a threshold. You either can or you can't. And I get it, especially when you're talking about larger funds, institutional grade funds. Those do require larger checks because those management teams are larger. Their expenses are higher, especially on the PE side. They're often offering operational help as well. It was just very dismissive the way that it was kind of said without any any explanation, but it was clear that I was trying to learn, get a sense for what this asset class required from investors, from individual investors, from institutionals and the like. The thing that really frustrated me, the more I learned over a period of time, was that he didn't explain capital call schedules. He didn't explain that you're not expected to write $1 million check today. You're expected to do it over time, over a capital call schedule. That's part of the process and part of how people actually make it into the asset class. $1 million doesn't seem so daunting over a 4 or 5 year period of time. If you tell me you have to write $1 million check in 30 days, it's a little different, And I'm talking about it as something that doesn't seem so out of reach because I think it's important for us, for women, for people of color to stop feeling like $1 million is such a large number that is, inaccessible. That's accessible through family groups. It's accessible through retirement programs and savings. It's accessible through lots of different means that perhaps don't seem obvious to you on the surface. But if it's something that you're really passionate about or an asset class that you want to get into, let's say you've already done equity through work, you have a real estate portfolio, you still have a job, you've done crypto, and you're like, okay, what else is there? And you want to kind of test how you get into this space. I think it's important to help people understand what it actually takes instead of saying these numbers very flippantly to almost create a barrier to entry.
Like a gatekeeping.
Yeah.
And that's why I wanted to ask that because in our world, all three of us are in different distinct industries technically, but we all have that same synergy of being in rooms where they're talking about 7 figures and it's very common.
Yeah.
The numbers are getting into like $100 million film funds, $100 million, $50 million business endeavors. And I know for you, especially in the VC world, the funds are way above 100 million sometimes. And so for our listeners and our audience to get that perspective of what is considered that entry level or that small check in this world compared to what they're seeing online or what they're hearing in the news. And especially when we get into AI, a lot of announcements are billion-dollar evaluations. So I just wanted to start off the conversation and giving people that sort of range and the fact that some of it can be attainable for certain people depending on where they're at in their finances and their careers. You can be an angel investor into something and start out with 5 figures, 6 figures, but over time of that venture or that fund, it equals out to being a 7-figure investment.
I was loving your intro because for me, as someone who's been in business and entrepreneurship, having more women in the space, especially more male-dominated industries, is like everything. That representation, just making it more accessible. What you're doing is like pioneering a path for other people to follow. So for me, it's such a big thing because I have been in rooms where I was the only female. And the only other females might have been administrative assistants versus people who are in the industry doing the job.
Decision makers.
The decision maker. So to see more women in tech, in business, in entrepreneurship, the idea that if you and your friends want to invest, you can pool your money together. A lot of times people look at it very individualistically, like, oh, I only have $30,000 or $50,000. But yeah, if you and 5 of your friends had $50,000 each, could you participate in something and get yourself in the game of investing?
Sure.
You also bring up another point about partnering with the right people and having good mentors because, like you said, people are going to gatekeep. And not because malintent. I think sometimes it's just oh, you're not in the industry, I'm not going to talk to you about it, but curious to hear from you on what resources you think people should go to educate themselves.
Well, I think the answer is AI, right?
Oh, there you go. Hey, because we had the AI chairs. Yeah, AI is a really good resource.
And to the point about, I need to say for sure, nothing we say today is financial advice or anything of that nature, but as a disclaimer. But, that idea of grouping can be grouping your finances. It could be grouping your knowledge. It could be working as a group to source potential investments. It doesn't necessarily mean that you have to do it all together. And if you really think about it, how much growth comes through that kind of community and group work? Immigrant communities, poorer communities, communities of color, whether that's you're investing in someone's small business or your customer number one or your cheerleader number one. A lot of the idea for how Open Venture Capital Fund 1 came about was, how do we do this from we all jump together? This is new for lots of us, but we're all going to make this jump together because even that is part of the de-risking. Part of what we're also doing is figuring out how to figure out our risk tolerance and take these leaps together. So there are ways to group your dollars together. A lot of that requires research and mentors to make sure that you're doing it on the
And
up
legal.
and up, and legal accountants and all the people.
All the people.
But I want to encourage group work.
So what you're saying is really about like collaboration, learning together, talking together, and also using expertise, knowledge, access.
Absolutely.
Networks. So I think that's actually really important because I think oftentimes people do look at it from just themselves. I have my 401k or I have some stock investments, but you want to continue to grow your wealth. You want to continue to kind of build a legacy. What are other ways that I can do that? So I think this concept for open venture capital is so great. I guess, did you feel like as AI has kind of come to the scene that it's changed how investing is happening?
I think there are two ways to approach the question. One is in the last 3 to 5 years, there have been new tools that have come about that have made it easier for emerging managers like myself to start a fund. Carta really came about, and other fund formation and fund administration platforms came about and made it easier to take like templatized tools to get the process started.
Okay.
And that made it easier for people like myself to start funds. Instead of maybe needing $1 million of your personal capital to start a fund, maybe you need 200K or 150K or something of that nature. So there's a world within which technology as a whole, and as AI has come to the forefront, has made it cheaper and easier for people to enter the space. And then the second is on the diligence side of things, the research and the diligence side of things. That's where we're starting to see this kind of convergence of the way that we all research using AI tools. And so you're starting to see that if you have the same investment thesis as another fund manager, or let's even say an angel investor, you have the same kind of idea of what it would take for a company to be successful. And then you start to do your research around the size of the market, the growth drivers, and you're kind of putting these same prompts into AI, you're going to kind of get the same information as everyone else, right? So there's a concern that there's a commoditization that will happen in the fund manager space or in that diligence space. I'm not terribly concerned about that because I believe there's a creative aspect and element to what you prompt your search engine or your research tools to look for. And I've been doing that well before AI was a large part of my diligence anyway. The differentiation you'll see is who's making investments kind of along the lines of where they see everybody else making investments, and who really has a standout thesis, almost a contrarian thesis, or at the very least very early to a thesis, and can get there and make those investments and then stick by their founders while the rest of the world catches up.
Well, every episode, we always get AI's take on the subject matter. We've been hearing all of the basis of, your world and where your foundation of what you're doing. But I'm curious to see what AI is going to say about this space. So in this episode, we are going to hear from Copilot. So let's hear what Copilot has to say.
According to Copilot, AI is rapidly reshaping startup investing, making it faster, smarter, and more predictive. Investors now rely on AI to sift through massive datasets, spot emerging trends, and evaluate founders with unprecedented precision. This allows them to identify high-potential startups earlier, often before traditional signals appear. At the same time, many startups are AI native, building products where machine learning and automation aren't just features, they're the foundation. This convergence of AI as both tool and product is driving a wave of innovation, but also fueling hype and inflated valuations. Ethical concerns around data use, bias, and transparency add complexity to the mix. Savvy investors must navigate this terrain with both enthusiasm and caution, separating substance from spectacle. In today's landscape, the smartest capital doesn't just chase AI. It uses it to invest with sharper insight and greater conviction.
Well, we are back, and that's what Copilot had to say about AI and venture capital. I know Lana is feeling some type of way of what Copilot said, but Kim, let's start with you. Thoughts?
That answer is what you would expect from AI, right? Like it almost lacks emotion and emotional intelligence. It's a pretty generic answer.
Textbook, yeah.
It's textbook. It certainly is reading the room, right? So it's talking through bias in the data. It's talking through where the value of the investor is and how that's kind of moved from just having access to early deal flow to really being able to diligence. Well, it's talking about predictive. It's talking about the thing that I actually do think is really unique to AI is that it's both the tool and the product. So like this convergence of these two landscapes. Are you using AI to be a better investor, or are you investing in AI because you believe it's the best investment?
Or are they doing both? Using AI to vet the deals and investing in AI companies?
Both are happening.
Yeah.
And even if you were to answer the question for your LP today, you would still leave yourself some room. Caveat, in 5 months, everything's going to be different because
that's what's happening.
That's kind of where we are, right? In the landscape of things. I think there are some things that I don't think Copilot touches on because it wasn't prompted to, or because it's not part of the conversation. And so some of that is around what about AI would make a company more successful today than it would have been 5 years ago if AI wasn't part of the mix. It's not going to answer that question because that's a prompt that I would have to put in there to say, in the sport, health, and wellness space, given the companies that we've tracked or liked, given everything you've known about me, and I've built kind of like my AI twin, and I've given you all this information about the way I think, now help me to understand what about this new company that I'm looking at displays the same qualities as a company I've liked before, but can get to profitability faster, and tell me the 3 reasons why. So I think unless we are prompting these engines appropriately, we're going to get generic answers.
I was also surprised that it didn't touch on how much VCs and investors want to invest in the people behind the startup. In my experience in talking to different VCs, a lot of times it's not just the product and the company, but also, especially in the startup space, really betting on the people behind the company to drive everything forward, to overcome any troubleshoots, hiccups, any marketplace changes, because that's really what launches the startup in the first place.
That might not be a mistake, right? Like, because the people have always been at the heart of early stage investing, right? We talk about this kind of confirmation bias. We talk about historically investors have looked for the Stanford grad or looked for the person that came from, name the large tech company and then spun out on their own, or looked for XYZ. So they were trying to recreate success based on the background of the person in the past.
Got it. And so that then makes a bias around that.
Correct.
Oh, I see what you're saying.
So what Copilot might be saying without saying it is, it doesn't matter anymore because...
Oh, facts. Actually, because we got AI. So then there's the democratization
and it's
around
the
that.
diminishment of the actual human in the space.
Wow.
I'm not saying that's what Copilot said, but it's what it didn't say.
That might be something. You're making a good point, and touche to Kim for that. 1 point for Kim on that front, where there is this level of democratization and opening up the gatekeeping and the accessibility with AI and investing in AI.
Well, yeah, and you can see that in the news in the current examples, because there's a lot of people who came from OpenAI, the top executives that have spun out and have gone and are starting to have their own companies, and they're raising capital, right? And they haven't really released a lot of information about what exactly their specific company is going to be doing.
Yeah.
But then they've raised quite a bit of money.
Then there's the opposite, where young college kids, 2 guys who within like 4 months were able to build an AI platform worth hundreds of millions.
Yeah. So it's an interesting environment. Yes, AI has kind of come into the scene. Now things are faster. And I think it's faster for founders. If they have an idea right before, you'd have to go assemble a team, raise some money, put together this company or some aspect of whatever product you're trying to show, and then go and pitch for it to continue to grow and get more investment. But now with so many AI tools, you are able to come up with a proof of concept much faster. And that's really great. But then are we in a sea of a bunch of people with proof of concepts? And is it just a lot of noise, or is it good? Did it just sort of allow for this big explosion of innovation and creativity and people starting startups? But then, now there's even more pitch decks to go through. And how do you sift through them all?
Let me try to break it into a couple of different aspects or angles. The first being, yes, it's new, it's fun, it's hot technology. It's actually not that new. It's just that in its current iteration, it's seeing major adoption in a way that 10 years ago, it was hard to have enough people have access to a model or a tool set that could be used by the layman. But if you think about technology in the last 20 to 25 years, this has been true for all technology that has changed our landscape, from the internet to e-commerce to the way that consumer products really saw a boom with paid marketing. That was a time when a lot of investors, they were making investments based on the math. If I put this much budget into this much paid, I can see these many new customers and we can grow this thing by 10x in a year. The part that's missing for AI, it's not formulaic yet. We don't really know if you put this much money into this much thing, what do you get on the other side? But the adoption of new technology and the rate at which people are able to adopt and move from you have to be an expert to use the tool to you can be a layman to use the tool. Shopify, that's why Shopify was so successful.
Yeah.
If you think about all the website builders, that's the spirit of entrepreneurialism in this country. I think what you're seeing is that those two worlds will continue to come together faster and faster every day. It also means that, yes, more companies will be started. More companies will not be venture scalable. More companies will be fighting for the same consumer dollar. The idea that there's an innovation and a moat, the idea that you have a defensible IP or a defensible product that someone else can't come in and create tomorrow to be your exact competitor, that is being challenged when we look at investments. And I would say that's true for all VC investors at this point. We've always asked, what's your moat? But now we really mean it. We're like, no, what's your moat? Because like, what would prevent two kids, in a dorm room tomorrow from recreating the same thing that you're creating? Yeah. What would prevent someone else from taking all the work you did and turning it into something cooler, younger, faster?
That just looks prettier.
Yeah. Maybe it only does half of what yours does, but it does that half better, and that's the half that's really valuable. Those are not new problems. Those are not new things. We're just putting AI on it. And so because AI at the moment kind of is valued at a premium, that also means the risk for loss is higher.
What we saw when the AI started being more open to the general public, right, when ChatGPT and then there was Copilot and Gemini, and so everyone's using AI, is that we would see all of these tools, AI magic and AI tool this, and every company had an AI angle overnight on their website. Okay. Now, whether it was AI, whether it wasn't AI, nobody knows. Yeah. It's interesting because I think now in the startup space, everyone has to use AI.
Not necessarily that their product is AI,
yes,
but that within their strategic plans, within their business plan, that there is some aspect of AI implementation.
Yes. The broader way to answer that question, the thing that I want people to really understand is that if you're an investor, the basis and the foundation for how you are reviewing a company and putting a company through diligence is not changing. You need to understand how this company is going to move from making $2 today to $100 million very fast. Not everything is meant to be venture scalable. We're trying to figure out what are the unlocks that need to happen to make this future universe true, where you would go from 1 customer to 100 customers tomorrow. So in that case, if you were pitching and your product is not AI-ified at all, but you're telling me that you can go from 1 to 100 because you've got an AI sales tool in the back, or you have the ability to scrape and then to run a full campaign, and you don't need additional headcount to do that. Those are all new considerations that I need to take into account. And I do think, founders need to be careful about trying to de-risk with just AI as the lever that they're going to pull, because again, that's not differentiated.
Right, because everybody's
doing it.
But maybe it's really more about how they're using the AI and what problem they're solving.
Yeah.
So what would be some green flags, let's say on the startup side? What would be some green flags that they should take into consideration that someone on your end would find impressive or of value?
On the front end, you have a product or a service that has a very large addressable market. Millions of people could use this thing, either underserved, not served at all, or you're building a better way to service this need. That's number one. That's at the heart of, whether or not we can even really take this into account. Then beyond that, how many people do you need to make your product, service, what have you, real? Is it already real by the time you come to me? How many people do you need to make it real? If it's 100 people to get to $100, then the math's wrong. We want to see your revenue line go up. We want to see your expense line stay flat and potentially even, kind of dip down. And the other part of it is because we are investors for, let's call it midterm, really like 5 to 10 year period of time, who's the potential acquirer for something like this? The story matters, right? It's not just like a green flag for green flag's sake. It really has to come together. There has to be several green flags to come together to make it make sense for your investor.
And you need a moat.
You need a moat.
You guys need to know your moat. If you get one thing from this entire podcast, you need a moat. I have talked to a lot of investors, especially in the tech space. And before, profitability wasn't really an important thing. If you were in a tech business, software as a service, for example, everybody just cared about the revenue, how many customers, reoccurring that you could get. But now in the conversations I'm having with other investors, that has started to change. What are your thoughts on that?
Well, not all investors didn't care about profitability. Several of us were like, when do you make money?
Yes.
So.
And as a business broker, by the way, we sell companies based most of the time
On EBIT.
On EBITDA.
On EBITDA, yeah.
And so it's really funny because I'm always talking about EBITDA and selling as a multiple of EBITDA. And then I'd be in the tech space and it would be a multiple of revenue and the business is not making any money. You're going to get this much money for a business that's not making any money?
Yeah.
And that was normal.
That's the difference is when you're buying a middle market enterprise grade business that is switching hands and you're financing it with bank financing, the bank wants to know how much money you are bringing in and how many times you can cover your debt service. That's a different capital structure. The companies that you're looking at, they're optimizing for their capital structure. On the venture side, the venture capital investors wanted to see growth. And the story that you could tell, we're not profitable yet, but when we get this growth and we don't have to grow our expense line at the same rate that we grow our revenue line, we will be. And because of that moat and because of the race and because of commoditization, grab as many customers as you can. Those are the things that could get you sold, because even if you weren't profitable, there's value there. And the reason that you've seen it shift is because the capital markets have shifted. So money's not, flowing the way that it used to. Maybe you raised a round in year one and then you raised another round 12 to 18 months thereafter. And now companies are seeing that they have to stay afloat for much longer before they close that next round of capital. And in order to do so, you're going to need some profit in order to stay alive. If you could be a great company and be dead in 6 weeks.
R.I.P.
What are you looking for within AI-powered companies?
There are some interesting conversations around the idea of this 1P, 1T idea, which is like a one-person,
One tech.
$1 trillion company.
What she's talking about is this idea that you could have one person create a whole company and that company be worth, first it was millions, now it's billions, now it's trillions. But it's just a one-person company.
Yeah, but it's happening so quickly. Even just like the last year, it went from a few $100 million. Now every startup is $1 billion company plus. And now in more recent times, it's already at the trillion. What is going on with this?
And how can I build this company?
After I build mine, I will build playbooks for you all, and then I'll sell them on IG.
okay.
I think you have to think of it as a North Star, as theoretical. How many people will get to the point where they are close to $1 billion without their investors being like, go hire somebody? It's unlikely.
Yes.
It's directional. It's meant to say you don't need as many people to get to large enterprise size as you did previously.
I completely believe this because I'm seeing it on a lower scale front, just in the entertainment industry. There are a lot of filmmakers and producers and content creators that are able to do things at a much bigger scale that previously, you had to be a mid-sized production company to do that. And then you have these mid-tier production companies that are able to do what studios are doing. To see how it's impacting it on the startup and investing side is wild because it's literally jumping from 100 million to $1 billion companies to $1 trillion companies within a year. So it is interesting how it's changing the overall landscape of the startup culture.
I believe it will change the way we work in the next iteration of whatever our future of work looks like, especially as AI starts to slow the pace at which hiring happens. I do think there's probably room for more fractional folks, same level of expertise, but not with the same amount of cost for a company. And that's a real disruption as well.
So let's go down this avenue a little bit more. With a lot more people, I guess, becoming more independent in the freelance or entrepreneur space, by default, you could technically say there'll be more startups.
They're not all venture scalable startups.
They might just be startup businesses.
Yeah, that's what I was going to get to.
If you think about all the folks that have started legitimate businesses through TikTok Shop,
Yes,
right?
There's like 7 million plus.
That's entrepreneurship right there.
Yeah.
That has nothing to do with AI. It has nothing to do with being venture scalable. Most entrepreneurs are just replacing their income. When you think about being venture scalable, it really has to be, we as investors are coming in and putting money into your company today. We're taking ownership stakes today. We believe that this money, let's say it's $1 million, this $1 million at this $10 million valuation, with this influx of capital, you'll be able to do something that you otherwise would not be able to do. You need this capital to do this thing incredibly well. And when you do this thing incredibly well, that valuation will go from 10 million to 50.
It drives up the value
in a shorter period of time than otherwise would have been possible. That still has to be true for venture scalable companies. Now, the two things that I believe will be different are there will have to be much more of a focus on brand and culture at an earlier stage, because in the past you'd hear people say like, don't spend money on brand. But if differentiation, if that moat is closing, if there's not as much time to be the differentiated brand, then you need another reason for people to follow you. You'll see a lot of investors today talking about community-oriented startups that are being leveraged by a specific sector or group and building that brand equity from a very early stage and for very little money. And that helps to be a differentiation in moat. And then the other thing that I think is important is that there will be some consolidation. There will be a lot of great companies that got to their seed stage of investment or their Series A or even their B, and all of a sudden they've got a couple of competitors and they either are going to have to consolidate and work together in order to become the size of company that they need to be acquired, or one will have to acquire the other.
I feel like we're going to need to have a part 2 because there are so many other things that we talk about that I know Kim would love to dive into more.
Should we play a game?
Yes. Before we wrap up, we got to play this game that you're talking about.
Here at the AI Chicks, we love to induct our guests into the AI squad by giving them a nickname. Okay. So, Kim, before we get started, do you have any nicknames?
Just not Kimmy.
Okay. Well, thank God.
So, do you have any other nicknames in real life? Childhood nicknames, friend nicknames?
I still do, actually, with my kids. I used to tell them that Kim Possible was named after me.
So that's actually one that I was going to bring up. I literally was going to say Kim Possible, and especially from this conversation, empowering everyone and educating everyone.
We're going to have to throw it in.
Because you're making things possible out here in these VC streets.
I would not be mad if I had some way to, prove to my children that Kim Possible was actually named after me.
All right. Okay, well, let's throw out a couple more.
Okay.
Because you deal with money and investing, just being a little fun. K-Money,
We had to drop the mic on the K-Money here.
We're just like K-Money in the house.
Yeah. Yes. What do you think about Investinista?
It feels like Budgetnista, who I love.
Okay.
I want to respect her space.
Sure. We'll respect her space. Okay.
But those were our 3.
Okay.
Yes. Kim Possible,
yes.
K-Money in the house.
Well, I mean,
and then Investinista.
K-Money feels very Brooklyn, and that's me all day.
All right.
K-Money, welcome to the AI squad.
Thank you so much. I appreciate it.
We really love that you joined us in studio. Thank you so much. I hope you enjoyed being on the AI Chicks.
Thank you so much. This was such an honor.
And for our listeners and viewers, thanks for watching. Make sure to subscribe. You can follow us on all the platforms where you get your podcast, as well as check out our website. And what else, Lana?
Don't forget to grab the merch.
All right, you guys, take care. Bye.
Listen to the AI Chicks on Spotify, Apple Podcasts, or wherever you get your podcasts. Video episodes are available on Patreon. And check out our socials at the AI Chicks.